In this video, I want to talk a little bit about internal rate of return and some of the issues with internal rate of return. Now, what we know is that people really like to use that technique. And I believe it's mostly just because of the ease, right? Percentages are easy to understand. Net present values, it's a little bit more complicated to understand how that works. So what we're going to do here is talk about the internal rate of return itself. So first thing we can talk about is we have what we refer to as net present value profiles. These are graphs where you take a project and you calculate its net present value at different levels of discount rates. So you end up with we can do it for three. We have a net present value profile worksheet that we can do this for 3 projects at a time and look at them graphically, if you will. So let's see what this looks like. Well, if you have a project that's independent, you're just looking at it all by itself, then there's no conflict. We don't have to worry about that. Net present value and internal rate of return will give the same answers. So if this is the internal rate of return, anything to the left of that, if we assume that it's an acceptable project, anything to the left has a positive net present value. At the internal rate of return, we say at that very point, that is where the internal rate of return is equal to the weighted average cost of capital. Anything to the right implies that the cost is more than the weighted average cost of capital. Anything to the left implies the opposite. And everything over here then has positive net present value. But when we look at 2 projects together, assuming that they are mutually exclusive, we have to pick the best of the 2. It really depends on what the cost of capital is, because there may be areas where, in this case, L is better than S for very low discount rates. But as we get to higher discount rates, S becomes more economical and more profitable for the company. So we need to understand the cost of capital and how that has influence over our acceptance or not. So here we can see that where the profile crosses the internal rate of return, both of those have internal rate of returns that are greater than the discount rate. But also, as I mentioned, for very low levels of discount rates, L has a higher net present value. So how do you choose which one to use? Now, our rule has always been that net present value always gives the right answer. But we notice here, and this is part of the challenges with internal rate of return, is that from time to time, it will create some conflicts with what we are deciding. One of the ways we can kind of look at these projects is we can just try to pick the best of 2 projects. Now, we could do that with just net present value, but it's nice to graphically be able to look and say, which one of these projects is best. And what we're using here is something called project analysis worksheet. And essentially you place the cash flows and then you subtract them. So we have negative 100 minus a negative 100, obviously that's 0. And you do that for each of these cash flows, and then you calculate the net present value for this incremental cash flow. And as you can see here, it says, should we do project 1? Well, it's a negative net present value here. So that tells us negative project 1 is not as good as project 2. The crossover rate is 8.68%. And if we slip back to this curve, we see that here is this crossover rate where it doesn't matter which project you look at that point, both projects are equally acceptable, if you will. Why is there a difference? Well, two reasons for the difference are size and timing of cash flows. Smaller projects, right? The higher the opportunity cost, right? The more valuable those funds will ultimately be because it's a smaller sale project. So high costs of financing favors smaller projects. Timing differences, though, if you get your money back quicker, right, that means you can reinvest it sooner. So two projects, two characteristics that are very different and both affect the value of the cash flows is the mere size of the cash flows, but then also when do those cash flows actually occur. So if you look at two types of projects that we can come across, normally we think about having a negative cash flow followed by a series of positive cash flows. So there is only one change in sign. A non-normal cash flow is where you might have more than one change in sign. So you have a negative cash flow followed by a bunch of positives, then maybe a negative followed by some more positives. These non-normal cash flows, and I don't like the word non-normal. I don't know how else to describe it, but non-normal makes it sound like it doesn't happen very often. But they happen all the time in manufacturing. And these are some of the kinds of issues that affect time value, so they ultimately affect the internal rate of return. So let's think about some types of cash flows and how that might affect the internal rate of return. Basically, we're just trying to illustrate that the internal rate of return has some weaknesses. And if you're aware of the weaknesses, you won't fall into traps in using that technique. So here we have a delayed investment, right? So the idea here is this a good deal or a bad deal? So here in this case, you're going to receive $1,000 today. So let's say this is some type of a book arranged or something. So you get $1,000 today, but because you get the $1,000 today, for the next 3 years, you're not going to be able to receive $500,000. So you have to give up work in order to receive this money today. Well, if you look at this, the net present value of this technique is negative $243, but it has an internal rate of return of 23%. I mean, 23% is an extremely high rate of return for a project. These techniques, in this case, internal rate of return, it really just doesn't make much sense to us. So let's look at what it looks like graphically, right? If you look at it graphically, it says what? As you increase the discount rate, we see that the net present value is increasing. And from a time value perspective, that just doesn't make sense. If you're increasing the discount rate, you should have decreasing net present values or present values in general. The purpose of this, again, is just to show that for some projects, internal rate of return just does not work. So let's look at another rule. What if we have some multiple internal rates of returns? In this case, we're going to kind of sweeten up this deal a little bit, right? So the publisher is going to give you $550,000 today, and $1 million in 4 years. But of course, you have to give up the cash flow in between. Again, should you accept or reject this offer? Well, let's look at the cash flow, right? If you get a 550 up front, but also you get this offer of $1 million in the 4th year, how does that look graphically, right? If you look graphically, you can see that it is this curvilinear function, right, that crosses the x-axis here at 0 in 2 places. Remember, where it crosses the x-axis here, where it crosses 0 net present value, is the internal rate of return. So the moral of this story is this particular asset has more than one correct answer. Every time the sign changes, mathematically, there is a potential answer to the problem. We can't have more than one answer. So again, there are projects where this internal rate of return just doesn't work at all. We could also even have a problem where we actually have no answer. There's no internal rate of return for the project. So again, the moral of the story here is internal rate of return is very easy to understand. But as decision makers, we have to understand that there are certain kinds of projects where it doesn't work well. And it would be advisable that you always do a graph so that you can see what's happening with the numbers, so you understand whether the project is feasible or not. And if it's not, maybe we need to use another technique. And we'll talk about some of those other techniques in a future video.